Welcome to today's Explainer. Today, we're objectively unpacking the MV Electrosystems IPO. We're going to weigh their absolute powerhouse of a market position against some, honestly, pretty harsh financial realities, just to see exactly what's under the hood of this upcoming market debut. So here's our roadmap for today. We'll meet the company, run through the key IPO details, look at their strengths and growth drivers, tackle those financial red flags, and finally land on our verdict. All right, part one, let's meet MV Electrosystems. Basically, these guys are manufacturers of advanced electrical systems, laser-focused on the railway sector. They aren't the ones actually building the trains, right? Instead, they provide the highly complex internal electrical nervous systems that keep modern rolling stock moving safely and efficiently. Breaking that down a bit further, they specialize in some seriously technical areas like IGBT propulsion and switchgear. It's essentially the heavy-duty tech that actually powers and controls the trains. Supplying this kind of crucial rolling stock equipment requires immense precision, which is great context to have as they gear up for their dual listing on the NSE and BSE. Moving right along to Section 2, the key IPO details. First up is the schedule, and honestly, the window here is incredibly tight. The IPO opens on July 30th and closes super fast on August 3rd. From there, tentative allotment happens the very next day on August 4th, with the official listing targeting August 6th, 2026. Literally, if you blink, you might miss it, which is exactly why having all these mechanics mapped out right now is so vital. As for the deal specifics, the price band is set at 400 to 425 rupees per share. With a lot size of 34 shares, your minimum ticket to entry is going to be 14,450 rupees. But here is the most notable part of the whole shebang. The total issue size is 290 crore, and it's 100% a fresh issue. No existing founders are cashing out early here. Every single rupee of this new capital goes straight into the company. Now, because they're taking a highly regulated listing route, the shares are distributed with a huge bias toward institutional stability. Retail investors, like you and me, are strictly capped at just 10% of the pie. Meanwhile, qualified institutional buyers, the big financial funds, they absolutely must absorb at least 75%, with that remaining 15% going to non-institutional, high-net-worth investors. So, what are they going to do with all these newly raised funds? Well, the company's very clear on capital deployment. They're heavily weighting a massive 180 crore chunk directly toward long-term working capital. This is really the central engine of their growth plan. At the same time, they're carving out about 21 crore specifically for R&D into new power electronics, with whatever's left over slated for general corporate purposes. Okay, on to Section 3. Let's look at the bull case, their strengths and growth drivers. The absolute crucial point in their favor is this massive executable order book sitting at over 921 crore. I mean, this is a staggering figure for a company that's only raising 290 crore today. It points to immense future revenue potential and really proves that there is significant locked-in demand for their systems. Plus, this massive backlog is protected by some incredibly high barriers to entry. The railway subsector is fiercely regulated. You need rigorous prototype tests and official RDSO Railway Authority approvals just to play the game. MV Electrosystems maintains this wide economic moat with a dedicated in-house engineering team of over 45 people and a government-recognized R&D unit. That effectively locks out new competitors from just swooping in. But we need to pivot to Section 4 and talk about the financial red flags. Because, wow, here is where the story takes a rather dark turn. The profitability reversal is stark. Revenue dropped from 62.64 crore in FY25 down to 49.43 crore in FY26. But the real shocker, the bottom line. After posting a pretty healthy profit of 1.40 crore in FY25, they essentially plunged off a cliff into a massive net loss of 12.63 crore in FY26. And the data shows this was largely driven by losses in that new R&D segment we mentioned earlier. And the P&L statement isn't the only place they're bleeding. The company is actively burning through cash right now. Operating cash flows plummeted into the negative, hitting negative 57.55 crore. Why? Well, it was driven by a heavy inventory buildup. It's actually kind of ironic. You have a nearly 1,000 crore order book on paper, but currently the actual bank account is gasping for air. This perfectly explains why they so desperately need that 180 crore of working capital from the IPO. Naturally, these operational losses trigger a cascade of frankly terrible valuation metrics for FY26. Return on equity is deeply negative at negative 31.55%, and return on capital employed is sitting at negative 17.69%. And since they actually have negative earnings right now, a basic EPS of negative 6.52, traditional valuation tools like the PE ratio are essentially broken. Valuations here are stretched to the absolute limit. Compounding all these financial struggles is an extreme single-point failure risk. A whopping 76.16% of their entire FY26 revenue comes from just one single customer, Indian Railways. Now sure, Indian Railways is an incredibly stable sovereign client, but having over 3/4 of your business entirely tied to the budgetary whims and procurement cycles of a single entity, that is massive, undeniable concentration risk. Which brings us to Section 5, the final verdict. Based on all this data, the analysis points to two very distinct paths. The short-term strategy? You could apply carefully, targeting a potential listing pop. The informal gray market premium currently sits moderately between 75 and 100 rupees, which hints at a 17.5 to 23.5% listing gain. But you absolutely need strict risk management for that. The long-term strategy, however, is a cautious wait-and-watch approach. Post-listing, the only metric that truly matters is whether they can actually convert that tantalizing 921 crore order book into real positive cash flow. So this leaves us with the ultimate question for anyone navigating this data today. Is a heavily protected moat and a massive backlog in the regulated railway sector truly worth inheriting severe negative cash flow, a recent massive earnings loss, and extreme single customer concentration risk? It's a fascinating tug of war between future potential and present reality. Thank you so much for joining me on this explainer, and I highly encourage you to keep these numbers top of mind as listing day approaches.